Longer-term yields are dropping, and that's making the yield curve even more inverted. So what does that mean for interest rates and real estate and the overall economy? Let's break it down.
Excuse me, Lieutenant. Is there something wrong?
Yes, ma'am. The data on the MiG is inaccurate.
How's that, Lieutenant?
Happened to see a MiG-28 do a 4G negative dive.
Where did you see this?
Started up on his 6 when he pulled through the clouds, and then I moved in above him.
Well, if you were directly above him, how could you see him?
Because I was inverted.
Good morning, everyone. Yes, yields are lower. Mortgage bonds are higher. We're up 14 basis points right now. We'll certainly enjoy that for the moment. We're going to examine that a little bit deeper. But yeah, the yield curve is certainly getting more inverted. We know what this means. It's a great recession indicator, and recessions lead to lower interest rates. And actually, that tends to be good for the housing market. We've seen through past recessions, home values hanging in there pretty well and actually going up. So let's take a look at this yield curve and see where the inversions are. They're pretty widespread. And I want you to take a look at this here. But first, before we do, I wanted to show you, when you take a look at the Treasury yield spread over time, when you do get inversions, they lead to recessions over and over and over again. Now, as we take a peek here at the current yield curve, I want you to pay attention to where the 10-year is right now. And this is the yield. We've drawn a black line here. But as you can see, the 10-year is beneath where the 7-year is, beneath the 5-year, beneath the 3-year, the 2-year, the 1-year. It's lower than all of those. So this is a pretty widespread inversion with some inversions here. Now, the lower end of the curve, the 1 month and the 3 month, that's lagging behind. But remember, the 1 month is going to follow the Fed funds rate pretty closely. That Fed funds rate at 1.5%. So you can see that 1-year Treasury a little above it. But you're going to get a 0.75% bump in just a few weeks here on July 27th. So that will push this lower end of the curve even higher. And who knows, with a little luck, maybe the 10-year a little lower. So we could be seeing more inversions here across the Treasury curve. And as I showed you, that does lead to recession-like conditions.
Now, Barry, we've seen this time and time again, but I have a question because I've heard from many news commentators. I can think of 3 just today on CNBC alone that they're talking about the fact that they don't see a recession on the horizon due to the fact that the unemployment rate is so low. Can you explain that?
I'm glad you asked that question, Megan. I just happen to have a chart that's ready to show that kind of refutes that. So let's go back here, and you can see we are certainly inverted. Now, what about the unemployment rate? Well, let's take a look at the unemployment rate and the coincident indicator with that and recessions. And you'll notice, Megan, what's pretty amazing here that most people, as you pointed out, we see them paraded on CNBC, constantly say, can't be a recession. Recessions occur exactly when the unemployment rate reaches its lowest level and then starts to tick higher. So would the unemployment rate probably have ticked higher even this month in the latest data that we got? Well, you remember when Dan broke down the numbers, he said that it went down, but for the wrong reasons. The household survey that gives you that unemployment rate actually lost 300,000 jobs, but more people than that left the labor market. So that's what held the unemployment rate at its lowest level. Look, eventually that unemployment rate is going to tick up, and that'll be a recessionary indicator. It happens over and over and over again, 100% accuracy. And that's because when people start to feel a slowdown, they let people go. Those newly unemployed change their spending habits. So we know that recessions occur not when the unemployment rate's high, but when it reaches its lowest level and goes up.
Also supporting that idea of a recession is the slowdown that we're seeing in small business optimism. We got the NFIB survey showing us that this month it dropped 4 points to 89.5. That's well below that estimate of around 93. And this is a 9-year low.
Yeah, and we're certainly seeing slowdowns everywhere in the economy. And if you look at some of the internals on the NFIB, just want to read a couple of them to you. So plans to hire fell 7 points to 19%. Still a lot of openings out there, but we're starting to see companies pause or anecdotally announcing future layoffs happening. Those that expect a better economy, well, that fell to an all-time low of negative 61%. Those that expect higher sales, negative 28%. Capital spending plans fell to the softest level since March of 2021. And those that expect to increase inventories declined by 3 points to a -2. And remember, that's a component that goes into GDP. Part of the reason why we saw an artificially strong Q4 GDP. And coincidentally, we've been seeing some negative numbers since then. So, inflation remaining the biggest problem, but clearly you could see small businesses not feeling good about the economy, especially with the backdrop of the Fed tightening.
Something interesting of note is the strength of the dollar. For the first time in over 20 years, $1 is equal to €1. Now, just anecdotally, I remember traveling and seeing $1.63 being worth €1. But again, for the first time in 20 years, $1 is equal to €1. So if we see travel prices maybe come down a little bit, maybe it's a good time to plan those trips to Europe.
Hey, I'm going in about a week. I love that. Now, also of note, we are experiencing a slowdown that's being felt in the housing market. According to a Redfin survey, 15% of agreements on existing homes were canceled in the month of June. Now, this is going to cause fear in your clients. Remember, media headlines are there to grab fear, but let's look at history to gain some perspective. Taking a look at this chart, we can see, yes, we have had a jump up, but when we take a look at history, historically, it is maintained around this 12 to 14%. That's the historical norm. Now, this is something that we are going to want to keep an eye on. And Diana, we also heard about a little bit of a slowdown in other news.
Yeah, we heard from John Burns Real Estate Consulting, a friend of MBS Highways, that in May, homebuilder cancellation rates were up 9.3% versus 6.6% last year. So based on this anecdotal data, home prices higher, rates a little higher, we are seeing a natural slowdown, of course. And on housing, thank you so much for all the responses on our survey. We've gotten over 3,000 and they're still coming in. So thank you for all your efforts there. We're already going through the data and we'll release the infographic for you in just a few days so you can share with your clients and referral partners. And later on this afternoon, remember two things. One, at 1 o'clock Eastern time, there will be a 10-year note auction. Could cause some volatility, so we'll keep a close eye around that time. And then later this evening, after the market closes, there will be a bond coupon rollover. Now, Dan, also some important news we're getting tomorrow, CPI.
Yeah, this is going to be a big report, team, really the highlight of the week. And expectations are for it to go from 8.6%, which was already a 41-year high, to 8.8%. But let's see how this breaks down by taking a look at some of the monthly numbers and some of the numbers we're replacing from last year. So when you take a look at this chart, you can see that the number that we have to replace from June of 2021 is 0.9%. So in order for this report to go up 0.2 from 8.6 to 8.8, well, that means that the new number we get tomorrow morning has to be at 1.1%. Now, that is a blistering hot reading. 1.1% in just the month of June alone is exceptionally high. But a lot of people out there, we hear them, they've been talking about how have we reached peak inflation? We're starting to see rollovers already in inflation. Well, seeing 1.1% certainly doesn't look like a rollover to me. But as we've been pointing out to you, people not looking enough steps down the chessboard, because look at what happens in July, August, and September. The numbers from last year, 0.5, 0.3, 0.4. Imagine if we get for July a similar reading. Now, listen, it's not 100% that we're going to get 1.1% tomorrow, but this is what's expected. But imagine if we got that in July. You'd see the number potentially go from 8.8 to 9.4%. Imagine if we get some hot readings over the summer here, you could see this number scare 10%, unless, of course, we start to really see things slow down. Remember, we do think that by fourth quarter, we'll definitely start to see those Fed rate hikes bite, because at July 27th, we're expecting another 75 basis point hike.
Let's take a quick look at the charts to see where we are right now. I'm going to go to the markets. As we mentioned earlier, mortgage-backed securities, they're doing okay. We're up 22 basis points right now. That 10-year is moving lower. And I want to take a look here at mortgage bonds with you, because we were on this 25-day moving average and things did hold on. We were patient with it. And thankfully, we've now seen a nice little move up over the last couple of days. But there is some overhead ceilings to contend with here that's going to make it difficult. And of course, tomorrow morning, we do have that inflation number, which is expected to come in kind of hot. But the markets, I believe, are bracing for it already. So what if we get a little bit of a softer number than the markets are anticipating? Could actually see mortgage-backed securities hanging there pretty good. 10-year Treasury is going to also be determined today by what happens with that auction that Diana mentioned earlier. So let's be careful and watch that auction at 1 o'clock. We'll begin the day floating into that auction and see how bonds respond. If we could float into it, we would like to be able to do that. The other thing to point out is after the close, Remember, as Diana pointed out, we do get a bond coupon rollover. So if you see prices suddenly drop after 5 p.m. Eastern, remember that's more than likely due to that rollover. Hope you guys have a great one. Bye-bye.